Attention F&I producers, this is for you. Why financing through the dealership makes sense. Welcome back. Today, I want to share something many automotive customers don't fully understand. When purchasing a vehicle, one of the smartest decisions a customer can make is allowing the dealership to arrange their financing. Most dealerships work with multiple banks, credit unions, and lending institutions. Instead of the customer shopping one lender at a time, the dealership can often shop several lenders at once to help find the best approval and loan structure available for their situation. Many customers automatically assume their personal bank is their best option. Sometimes that's true, many times it's not. Here are a few reasons why dealership financing can work in the customer's favor. First, dealerships often have access to multiple lending sources. That means lenders compete for the customer's business. More competition can create better options, better terms, and sometimes lower payments. Another advantage of financing through the dealership is convenience. Instead of wasting time calling banks, filling out applications, waiting for callbacks, and comparing offers one at a time, the dealership can often do all of the work for the customer. It's one-stop shopping. The customer can select their vehicle, value their trade, arrange protection products, and review multiple financing options all in one place. For many customers, that means less stress, fewer appointments, less paperwork, and a significant amount of time saved. A customer's time has value. The ability to compare multiple lenders through one application can make the entire vehicle buying process faster, easier, and more efficient. Second, dealership financing may require less upfront cash or initial investment. Because dealerships have strong relationships with multiple lenders and lending institutions, they often have access to a wide variety of financing programs designed for different credit profiles and financial situations. These relationships can sometimes help reduce the amount of money needed at delivery while still helping the customer secure the vehicle they want. Third, many customers don't realize that some financial institutions use something called a right of offset. The right of offset is a legal right that may allow a financial institution to withdraw funds from a customer's checking or savings account if the customer becomes delinquent on a loan with that same institution. The exact terms can vary depending on the lender, the account agreement, the loan contract, and applicable laws. For example, let's say a customer has $10,000 in a savings account and also has a vehicle loan with that same bank. If the customer falls behind on the loan and the loan agreement permits it, the bank may have the ability to use money from the customer's deposit accounts to satisfy some or all of the delinquent debt. Think about that for a moment. If a customer keeps all of their money in one bank and also borrows money from that same bank, they may be tying their borrowing relationship directly to the accounts where they keep their money. Many financially successful people understand the value of separating where they store their money from where they borrow their money. They often use other people's money to acquire assets while keeping their banking relationships separate. That's not because they're trying to avoid responsibility. It's because they understand risk management and financial flexibility. Even if a loan from another lender carries a slightly higher interest rate, many customers feel the added separation and flexibility is worth considering. Fourth, some lenders use cross-collateralization. Cross-collateralization means one loan or asset may be used as security for multiple obligations with the same lender. For example, a customer may have a vehicle loan, a personal loan, a line of credit, and other borrowing relationships with the same institution. Under a cross-collateralization agreement, those obligations may become connected. That means collateral securing one loan could potentially secure another loan as well. In simple terms, if a customer experiences difficulty with one obligation, it could affect other obligations with that same lender. Many customers are unaware of these provisions until after they have signed their agreements. This is another reason why it makes sense to understand all financing options before making a final decision. Fifth, most auto loans today are simple interest loans. With a simple interest loan, interest is calculated based on the remaining principal balance. In many cases, customers who make payments on time and pay extra toward principal can reduce the total interest paid over the life of the loan. The bottom line is this: a professional finance department helps customers compare options, understand the fine print, and make informed decisions. The goal isn't just getting approved. The goal is finding the financing solution that best fits the customer's needs, budget, and long-term financial goals. Give the customer the advantage of exploring all of their options before making a final decision. The dealership's finance department works with lenders every day and understands the programs, incentives, terms, and opportunities that may not be available through a single banking relationship. Smart financial decisions are not always about finding the absolute lowest interest rate. Sometimes they're about flexibility, protecting cash flow, preserving banking relationships, reducing the initial cash investment, saving valuable time, and choosing the financing structure that best serves the customer's overall financial picture. The more informed the customer is, the better financial decisions they can make. I hope you found this information helpful with your next showroom customer. Remember, experts in their field always earn the highest incomes. See you soon.